Listen to the floor of a classic stock exchange, and you hear raw, unbridled chaos. Millions of dollars changing hands every second, driven by humans and machines trying to outpace each other in a high-stakes arena. It's easy to look at that environment from the outside and assume there's a secret code to crack. Many beginners enter this space believing that trading is a mechanical puzzle, that if you just find the right indicator or the perfect mathematical pattern, you can predict what prices will do next and generate wealth on demand. Social media feeds amplify this belief, highlighting rare success stories while conveniently ignoring millions of wiped-out portfolios. This creates a powerful survivorship bias that masks the quiet destruction of capital happening every single day. This pie chart illustrates the reality behind the trading screens. According to data from European financial regulators, between 74 and 89% of retail accounts in leveraged markets lose money. That massive red section represents everyday people who saw their entire accounts drain away, leaving only that tiny blue sliver of long-term survivors. The vast majority of those losses stem from a single error in how we think. People approach the market trying to predict exact future prices, but financial markets are inherently probabilistic. Claiming you can foresee the next move with total certainty is scientifically impossible. Survival in this environment depends on the rigorous management of uncertainty. Professional longevity comes from prioritizing the consequences of being wrong over the hope of being right. Unlike a simple machine with fixed gears, a financial market acts like a living organism. It is a complex adaptive system, made up of millions of human participants and algorithmic bots, constantly watching and reacting to one another. The investor George Soros described a concept called reflexivity. He observed that the actions of traders alter the market's reality. If a specific analytical pattern starts working and everyone jumps on it, the market adapts, absorbing that collective behavior and making the original pattern useless. Because the system is constantly adapting, there are always unknown variables waiting in the wings. Sudden geopolitical conflicts, unexpected policy shifts, or global health crises act as black swans, highly improbable events that instantly break historical models and tear right through technical indicators. Look at this panel from the Swiss National Bank. In January 2015, they held a press conference and suddenly removed the cap on the Swiss franc's value against the euro. Within minutes, the currency surged over 30%. During those chaotic minutes, market liquidity completely evaporated. Traders who set strict stop-loss orders to protect their accounts watched helplessly as safety nets failed. There were simply no buyers or sellers available, exposing accounts to catastrophic slippage. Systemic shocks wipe out multi-billion-dollar institutions as easily as retail accounts. Even portfolios managed by Nobel laureates have collapsed when their underlying models failed to account for a total liquidity void. Nobody is immune to systemic risk. Placing all your capital on a trade because you have absolute conviction in your analysis, without ensuring you have the liquidity to survive the unexpected, leads straight to financial ruin. This is why amateurs and professionals ask entirely different questions. A beginner looks at a chart and asks, will the price go up or down tomorrow? A professional asks, if I am right, how much will I make? And if I am wrong, exactly how much will I lose? Professionals operate purely on expected value. Think of how a casino works. The house doesn't know who will win the next hand of blackjack, and they don't care. They know that across thousands of hands, they hold a slight statistical edge. Over time, the math guarantees profitability. That edge is rarely about being right all the time. Novices obsess over finding strategies with an 80% win rate. But if you win 8 trades and make $1 each time, then lose $10 on your 2 losing trades, you are still walking away poorer. The true threat to a trader's survival is drawdown, and this chart shows exactly how it works. Drawdown is the percentage drop in total capital from a previous peak. Notice how as the blue account balance falls by 50%, the red bar indicating the effort required to recover climbs sharply. To get back to the starting line after a 50% loss, you don't need a 50% gain. You need a 100% return on your remaining money. As the losses deepen, the math becomes exceptionally brutal. If your account drops by 80%, you now require a near impossible 400% return just to reach your initial break-even point. Consider 2 different approaches to the market. Trader A uses heavy leverage to double his money in a month, only to encounter a sudden market shift that wipes out 90% of his balance. Trader B strictly risks just 1% per trade. Her account grows slowly, but she experiences almost zero drawdown, keeping her capital intact month after month. After a few years, Trader A is entirely out of the game. Trader B is quietly compounding her wealth. Professional trading is an exercise in defensive drawdown management. You have to aggressively protect your capital so that you are still sitting at the table when your statistical edge finally plays out. If you browse financial forums, you will inevitably see promises of systems generating 100 to 500% returns every single month. Targeting those kinds of returns requires taking on extreme leverage, mathematically guaranteeing that a single unexpected event will trigger a total liquidation. To set realistic goals, look at the actual benchmarks of financial greatness. The most successful institutional wealth managers in the world typically average an annual return of between 15 and 25%. Warren Buffett built one of the largest fortunes in modern history. He achieved that by maintaining a compound annual growth rate of roughly 20% over a span of more than 50 years. His track record proves that long-term consistency vastly outweighs short-term intensity. The actual mechanism of wealth creation is compound growth. By keeping account volatility extremely low and securing modest, consistent profits, the gains begin to multiply exponentially over time. Embracing this slow burn approach requires a strict psychological framework. To a professional, executing a trade perfectly according to a tested strategy that happens to lose money is considered a good loss. Conversely, taking a reckless, oversized position that gets lucky and makes a fortune is a bad profit because it reinforces undisciplined habits. This framework integrates probabilistic thinking, risk management, and behavioral control. When combined with realistic return targets, these elements form a cohesive structure designed to withstand market volatility. The market acts as a perfectly neutral mirror, reflecting an individual's internal discipline back at them in real time. By shifting focus from predicting prices to controlling risk, a trader aligns their process with the same mathematical realities that sustain the world's most successful firms.